problem most Dubai real estate investors run into. You hear one agent say, just invest in Dubai South. Another one says, Dubai Islands is the only area that is worth it. So today, I'm ranking 7 groups of Dubai areas from worst to best investments. Starting with number 1, areas with no future development. These areas are the worst for real estate investing because they're the most dangerous. At first glance, they look like any other good area in Dubai, but they're masking a problem. Let me show you how. Here are 4 areas. They all seem like they're actively developing. Can you spot the weakest one? Let's see. The first one is Dubai Land Residence Complex. It has 24,000 units under construction, so a lot of construction is going on. The second is Production City, with 9,000 units under construction. The third one is Motor City, with 13,000 units. And the last one is GVT, with 11.5 thousand. So all of them look like they're growing. But the trickiest one is Production City. Let's take a closer look. This area is developing indeed. 9,000 units under construction is quite a lot, but this is not the kind of development you want as an investor. A lot of residential units are being built. No schools, no hospitals, and these are exactly the things Production City is lacking today. Here's the metric to quantify the issue. Let's look at how much retail space the area has per each home. We take all the retail space in the area, ready and under construction, and then we divide it by the total number of residential units. And it's a very important metric because it shows how livable the area is. Production City has 11,000 homes today, and then we add everything that's under construction, and it's gonna be around 20,000 residential units. Against those 20,000 homes, we're gonna have 260,000 square feet of retail. That's 13 square feet of residential space per one residential unit. Every neighboring residential area is above that. Arjan is about 18, GVC is 23, and the best areas are on another planet compared to that. Dubai Hills has about 81 square feet per home. That's 6 times more than Production City. And when Dubai Hills was in its phase of active infrastructure growth, it delivered superior returns to its investors. Look at this chart. It shows the average price per square foot in Dubai Hills. The growth is 130% over 7 years. 10 years ago, Dubai Hills already had 2 strong schools. Then came the park, the hospital, and finally, Dubai Hills Mall. Now it's one of the most demanded residential areas in Dubai. The good news is that you can check any area in Dubai for this problem. For that, you can use the Area Growth Tracker. This is something we developed inside Forever Estates. It's an online tool. You open it up and it shows every Dubai area on the map. You click on the area and see its historical growth, ready and off-plan prices, current supply, and future supply. You can check the retail units too, so you can see the retail to residential ratio yourself. It's free and it takes 10 seconds to get. Scan the QR code or click the link below to get access. This tool will help you spot the areas with no future development. And it will also help you to reveal the second category. Number 2, oversupplied areas. An oversupplied area is also very dangerous for investors. First, because many people invest without knowing what's gonna happen in that area. Second, because for some investors it's not an obvious issue. They see how the area is performing right now, and they think that's a great investment. Here's the real example. It's an area that has been steadily growing. The average price there increased by 33% over the last 3 years. So it's even a bit faster than the market, and it's one of the best in Dubai in terms of rental yields, 7 to 8% on average, depending on the unit type. But this area has exactly the problem we're discussing now. There are 52,000 ready units there, and 34,000 more are under construction. So in just a few years, this area will have more than 85,000 units. And this area is GVC. Soon it's gonna be 4 to 5 times larger than any neighboring area. GVT, Arjan, Motor City, and all of them will have much lower density. But GVC is the example everybody knows. There are new locations developing right now that have a different variation of the same problem. This is a relatively small community under construction. In total, they're gonna build more than 12,000 units. Around 5.2 thousand have been launched, meaning they became available for buying. And out of those more than 5,000 units, 2,750 are still in stock. So the project launched many months ago, but they still have a lot for sale. And if you'll decide to resell during construction, you will not just compete with other resellers, you will also compete with the developer. And all the units here will be built around the same time, so there will be a huge influx of new units at once. That creates a very high level of competition. And in a situation like that, you will struggle to resell with a premium. This is not the first time we have this situation in Dubai. There was another example where a lot of units were handed over simultaneously. Those owners who tried to resell at handover made almost no profit. But the good news is that later, the market absorbed all the supply and the prices went up. Those who waited longer were still able to make profitable exits. So, people go for areas with oversupply risk. They think they're investing in something that is actively developing, and that is why they expect to get higher returns. But those who want more predictability often invest in number 3, mature areas. Mature areas are the communities that are fully or almost fully built. All the infrastructure is in place, occupancy is high, off-plan projects might happen there, but not that often. Most of the area is just built out. So because not many things are happening there, these areas are, by design, will never deliver the highest returns. They are not the worst investments either. They have one significant advantage, and that's predictability. The rental yields are predictable, and the growth is predictable. The main example here is Dubai Marina. Everybody knows Dubai Marina. It's a very developed area. Almost no buildings are under construction. And the average property value there grew by around 30% over the last 3 years. That's close to the market average. And it's fair to say that Marina represents the market average. The rent-to-price ratio for one bedroom in Dubai Marina is around 6%. That's pretty much the average for one bedroom in Dubai overall. If you invest in an area like that, you have to accept you will not outperform the market. There is no new development, no new schools, no new roads, nothing that can push the prices up. And the prices are already high compared to other areas in Dubai. Sometimes the gap between a developed area and an early stage area of a similar type can be 30%. So probably one of the only ways, if you want to invest in a mature area, get the predictability of a mature area, but still generate returns higher than market average, is flipping a renovated property. This might work in areas like Blue Waters. Blue Waters is an iconic area with a very low supply. So there are people there who are buying normal apartments, upgrade them, and resell with a nice premium. Active flipping is, by the way, one of the main reasons why Blue Waters grew so much over the last 5 years. Renovation is harder now though, because of the market situation. And if Blue Waters and other mature areas are above your budget, you might want to pay attention to number 4, affordable areas. So we're talking about apartments in areas like Motor City, JVT, or Dubai Land Residence Complex. The normal price for one bed in an area like that is around 1.1 million dirhams, or about $300,000. Just for comparison, a one bed in a mature area, something like Business Bay, will be around 2 million dirhams or $550,000. So the entry barrier is significantly lower. What you should know is that affordable areas usually have no price gap compared to ready alternatives. I mean, off-plan prices are pretty much the same as ready prices. So that leaves no room for extra growth on top of the market growth. So they grow in line with the market average. And this kind of expectations management is what we do for many of our clients investing in the affordable segment. If you invest in a low budget tier, you shouldn't expect rapid value growth. What you can expect instead is a good rental yield, better than in well-known mature communities. Here are several examples: JVT, Al Furjan, and Motor City. Look at their rental yields. All of them show 7 to 9% rent-to-price ratio. And these are averages, which means some properties there are generating 10, 11, or even 12% rental yields. And there is one affordable area I haven't named in this section. I want to tell you about it in the next category, because even though it's affordable, it belongs to level 5, resilient areas. I talked about this long before the recent events that happened in the region recently. But those events gave us a real-life data on which areas go through downturns better than others. If you want a stable cash flow, if you want to resell at a good price even when the things go wrong, that's when you invest in resilient areas. The reasons why they're resilient can be pretty different. But now I want to tell you about Arjan. What's interesting is that during the hottest phase of the recent situation, and after it passed, prices in Arjan stayed in their normal range. Resale prices didn't drop, and the same thing happened with rental prices. Unlike other communities, renewed contracts in Arjan stayed at the same level. It's a bit weird, right? It's not such a unique area. It's not the best place to live in Dubai. There is not much greenery, and most buildings are pretty average. The reason is simple. In a similar class of areas that give you the same level of convenience, there is nothing cheaper than Arjan. Think about the resident profile. These are people who are budget conscious. They usually own a car and drive to another area like Business Bay for work, which is around 20 minutes away. They can get to Dubai Marina in 15 minutes, and to Mall of Emirates or Dubai Hills Mall in 5 or 10 minutes. An average Arjan resident renting a one-bedroom pays 72,000 dirhams, or 19.6 thousand US dollars per year. Look at the alternatives nearby. Better areas like Dubai Marina are priced at 90,000 dirhams per year. That's $24.5 thousand. Something a bit simpler than Marina can be GLT, and in GLT you'd have to pay 80,000 dirhams or 21.8 thousand US dollars. Even JVC is slightly more expensive. And moving out to distant areas like Dubai Land Residence Complex or Silicon Oasis is not really an option because these people value their location. So they have no other choice. They are staying where they are. That's why landlords here are able to get a 7% gross rental yield. This is before service charges. So they have a stable rental demand and they have no urge to sell. Prices stay stable too. This is just one example. We recently made a deep dive video on resilient areas. I'll leave the link in the description if you want to check it out. But these resilient areas are about stable cash flow. They will not outperform the market. And if that's what you're after, you should consider level 6, early stage master communities. This term is used a bit differently by different people in Dubai, so let me clarify what I mean. First, there is a master plan. So there is a developer who defines how the whole community will evolve. And I'm not just talking about the residential buildings. It's about the whole ecosystem. Schools, hospitals, roads, and basically the whole infrastructure. Second, we're talking about closed master communities. So the master developer is the only one, or almost the only one, allowed to build in the area. And third, the community should be at an early stage of its development. First, second, or third phase. Not all master communities are great. Some of them can be pretty disappointing for investors, and I'll talk about that in a minute. But the successful ones are successful because developers apply the same scheme over and over again. They launch the first phase at a certain price. Then they launch the second one. The properties are pretty much the same level, same design, same quality, but the price is higher because it's the second phase. And because of that, prices for the first phase grow to match the second one. Then they launch the third phase and the prices are even higher, and then they do the same with the fourth one, and so on. Each new phase pushes the older prices up. Good developers keep doing that even if the market prices are not growing, even when they're falling. During COVID, for example, Emaar kept slightly increasing prices in their communities while the whole market was down, and that protects the investors. So if you choose the right community, this is a fairly predictable way of securing returns above market averages. But I also said some master communities are disappointing. Here's the thing. The success of Emaar's master communities made investors aware that this format performs well. So now developers and real estate agents are pushing many apartments as apartments in a master community. And that's how they justify the reason to invest. But those projects eventually fail. First, because many developers don't have enough land. To be successful, you need to launch many projects over a long period of time. For that, you need a large area. And not every developer has that. Second, building a master community is not just building residential towers. Some developers are not investing much in infrastructure just to save money. Some are not that good at developing concepts and building them. But retail, roads, hospitals, schools, they're essential for a community to succeed. And finally, to build something at that scale, the developer must be strong financially. A truly great master community takes 5, 7, even 10 years to complete. For some developers, that's just not possible. They need their money back fast, so they develop the whole land plot fast. Emaar is the best at this, and their communities are really good for this strategy. But there is another example emerging right now, and this is Beyond in City of Arabia. They acquired a huge plot, and they're building a real full-scale master community. Residential buildings, parks, lagoons, retail, and offices. 70% of the land is promised to be green space, and no cars will be allowed inside. Phase 1 sold out in a day. Phase 2 launched at around 10% higher prices, and that's the exact pattern I just described. Already repeating, in Phase 1, a one-bedroom started at around 1.1 million dirhams or $300,000. The same one-bedroom in Phase 2 starts at around 1.2 million dirhams or $327,000 just a few months later. So, early-stage master communities can generate you high returns indeed. But the highest returns among all areas in Dubai are definitely on level 7. And I'm proud to say that the absolute majority of our clients invest in level 7. The ones who landed on the lower level did that for one reason: their budget. So, if you're serious about investing in UAE real estate, get a free consultation with us. You'll get advice based on data, financial analysis, and years of experience in this market. My team and I will walk you through the whole process. We'll show you all the numbers and lay out all the facts, so you can have everything you need to make an informed investment decision. And when you decide, we'll use our developer relationships to get you the best units on the best terms. To get in touch with us, message us on WhatsApp. The link is in the description. Level 7. Early stage beachfront areas. Okay, this should make sense. Beachfront areas are some of the most lucrative investments in any global city, not just in Dubai. But there are several things investors get wrong about the new Dubai beachfront areas, and that's how they leave a lot of money on the table. This category has two components. First, it should be an early stage area. Palm Jumeirah is great, and it has generated amazing returns to its investors because of the rapid growth over the last few years. But it's now priced very high. That growth has already realized most of the potential. So to get higher returns, you should go for early stage areas. Their value gap versus ready alternatives, Palm Jumeirah included, is still significant. Second, when I say beachfront, I literally mean beach access. Real sand, real sea, and you can swim in it. I'm stressing this because in Dubai there are many areas with artificial beaches and artificial lagoons. That's not the real sea. And there are also many areas that are by the sea but have no beach at all, just a boardwalk. So the investment thesis is simple. Beachfront properties in Dubai are limited in supply, and at the same time they're in high demand from both residents and tourists. So to make the highest potential investment, you amplify both sides. You look for what is the most undersupplied and the most demanded sub-segment inside the beachfront segment, and it's private beachfront. Beachfront properties are around 5% of the total city supply. Private beachfront properties are under 1%. So they're truly scarce, and they're almost exclusively in the ultra-luxury segment. But right now on Dubai Islands, there is a short strip of land where new projects are getting built with direct private beach access, and with a huge price gap versus similar ready units in developed areas. When I say huge, I mean up to 50%. So if you take the best units on this strip, you get golf course views, sunset views, sea views, and direct private beach access. And some of them come with a very limited supply. The best project there has just 99 units. The apartments come fully furnished and fully serviced. They're managed by an international hotel brand. And if you want, you can go even further. You can go for even higher demand and even more limited supply. Less than 0.3% of all properties in Dubai are beachfront houses. And on Dubai Islands, there is gonna be a new private island, accessible by residents only. No hotels, no tourists, no apartments, just villas. And villas there are gonna be priced up to 2 times lower than comparable ready units in areas like Palm Jumeirah or Pearl Jumeirah. This is what makes it the #1 opportunity in Dubai real estate right now. So now you know all 7 levels from worst to best, and you should be much more intentional about where you invest. There is another crucial question though: which developer you should invest with? Here's the video that will help you out.